Are you ready to build, grow, and protect your investments? Welcome to the Index Investing Show, where we give you the tips, tools, and philosophy for reaching your financial goals. And now, your host, inventor of the Portfolio Report Card and author, Ron DeLegge.
All right, welcome to another thrilling episode of the Index Investing Show. Coming up on today's program, I'll be doing a Portfolio Report Card for TJ in Glendale, Arizona. She has a $322,000 inherited IRA. And how does this portfolio grade? Does it get a passing grade of A, B, or does it fail to have a satisfactory grade? So you'll find out on today's show. We'll drill down and look at TJ's portfolio together and see if it passes or fails. If you'd like to join us to talk about anything financial on your mind, if you want to discuss a particular investment strategy, stock, mutual fund, ETF, you know the drill. 844-305-7800 is the number. Give us a call. You give us your first name along with your city and your ticker symbols. You can also tweet the program live at Index Show. On Twitter is where you find me. And just drop us a tweet there. You can also email me, ron@indexshow.com. So taking a look at what just happened thus far this year and this past week, we finished the first quarter, and what do you know? It was market. He jumped 14%. And it was a good quarter, good start to 2019. VEA, which tracks international stocks, and then we've got VWO, which is linked to emerging market stocks, also ahead double digits, about 11 to 12% thus far in 2019. So we see that international stocks as well as U.S. stocks pretty much following the same routine of heading higher. We've got global REITs ahead by just over 15%. That's been a great performer thus far this year, one of the leaders in terms of major asset classes. Real estate is a winner in 2019. As far as commodities, they're up as well as bonds, but modestly so. We've got the total U.S. bond market up about 3%, ticker symbol BND, and then USCI tracks commodities ahead just a nudge over 3%. So that's your big picture view of what's going on in terms of market performance. We focus on price because price is a leading indicator. All these other things that you hear about, non-farm payrolls, the unemployment rate, and all these other things, these are all secondary, what I like to call noise. Noise that really confuses us. It gives, commentators on the news something to talk about. It gives them something to write about, but it really doesn't give us much in the way of actionable investment strategy, so to speak. We've got to focus on price, and so that's what we do on this program. We give you a big picture view of where the price action is, what's going on, where's the price momentum, and also taking a look at the market in terms of sentiment. Prices tell us about the market's mood. Right now, I will tell you the market is in a risk-on sentiment mood indicator. That's where the market's at. It's risk-on right now. We saw that this past week with the IPO of the taxi service, whatever you want to call it, the hailing app Lyft, which rose and debuted this past week, and they couldn't stop talking about it. But that's the sort of climate, the backdrop that we have right now. And when we see IPOs, and there will be more coming to market, but this is a signal that that markets are ripe and happy to accept risk. Now, of course, it could change on the dime at any moment, right? So this is why we have to be ready for any scenario. And so that's why the prudent way to build your investment portfolio is to have exposure to all the major asset classes, not just stocks or whatever's just doing well right now, because that can change on the dime. That's the way financial markets work. And also the other thing I want to mention too, the whole point of building an architecturally sound investment portfolio that minimizes cost, minimizes risk, maximizes diversification and performance, and also, by the way, minimizes taxes. The whole point of this exercise is to increase the odds or possibility of a positive outcome for you. That's the objective, people. I can't predict what the future is going to be. You can't predict what the future is going to be. No one else can. We don't know what the financial markets are going to be like in 24 hours from now or in 24 years from now. But what we do know is we can control the amount of risk we're taking. We can control the cost of our investments. We can control to some degree taxes. We can control to some degree diversification. And if we take care of those things, performance that is satisfactory should follow. So these are the things that we're trying to help you understand. And this is one of the reasons this program even exists. 844-305-7800 is the number. You're listening to the Index Investing Show. I'm your host, Ron DeLegge. So we're going to take a look at this inherited IRA. It's from TJ in Glendale, Arizona. This is a $322,000 account. And TJ went to PortfolioReportCard.com and reached out to me, wanted to have her portfolio analyzed and graded. Now, something that you should know about inherited IRAs, so this is a non-spousal inherited IRA. So in that case, you have to take distributions on this. That's the way it works. And the distributions are much like RMDs. RMDs are something that happens at age 70 and a half. And age 70 and a half, you know, those of you that have reached that threshold, you have to take distributions. You have to start taking income out of your traditional IRA, if you've got a 401k plan or simple IRA, you've got to start taking money out because the IRS wants to get paid. And so with an inherited IRA that's non-spousal, that is the same kind of thing. Generally, you must take your distributions during your lifetime or within 5 years after the original account holder has died. So that's the situation that TJ finds herself in. By the way, I should mention that those of us that do have a spouse that passes and we inherit their IRA, right? Because spouses should typically name each other as beneficiaries. So in that case, it's different. Yes, it's an inherited IRA, but the rules are different for inherited IRAs for spouses because a spouse can have that become their own IRA. So they can do what's called open up an inherited IRA and then or transfer that rather into their own IRA and have that become their own retirement account. And so that's very different. If you are a non-spouse and you inherit an IRA, you cannot do that. You can't just take an IRA and have it become your retirement account. As I indicated earlier, you have to start taking distributions on that. And like I said, it's got to be over during your lifetime and within at least 5 years after the account holder has passed away. So, TJ, we're going to look at the account holdings coming up next. We'll drill down what exactly this $322,000 inherited IRA consists of. And then we'll look at those 5 key areas. How does the portfolio do in terms of cost? How does it do in terms of risk, diversification, taxes, and performance? And then we'll give TJ a final report card grade of A, B, C, D, or F. Does TJ pass or does TJ fail? You're going to find out on the program. Also, we'll take a look at what some of the key industry sectors and the ETFs tracking them are up to. I'm Ron DeLegge. I'll be right back after this short break.
Do you have an investing or retirement plan question? Tweet the program right now or follow us on Twitter at Index Show.
So we're going to take a look at this inherited IRA. That's what today's portfolio report card is all about. It is an inherited IRA, $322,000 account for TJ in Glendale, Arizona. This is what she has right now. And but when we talk about inherited money, it's typically emotional money because of the fact that the people that have left this money behind to us as the heirs, we are in some way, we're obviously grateful for that, but also it's difficult to really think about this money as our own. And typically with money that's inherited, it was invested in a way that was compatible with the person that passed away, but we've inherited this money, and the problem now is that strategy, is that investment mix compatible for us as the heir? And usually there's a large discrepancy in that, and it's quite common with inherited money. But inherited money, again, is emotional money because it's difficult for us to separate the emotion from the logic of what we should be doing. And so in this case, again, this is an inherited IRA. We told you earlier that non-spousal inherited IRAs are treated very different than inherited IRAs from a spouse. Remember that non-spousal, and this is what we're dealing with here for TJ, distributions on this within 5 years of the passing of the person that has gifted her or bequeathed this money to her. And so she has chosen, she indicated, the 5-year method. Basically, she's transferred these assets into an inherited IRA that's held in her name, and then the money's available at any time up till the end of the 5th year, and then she's got to start taking distribution. So she's got that 5-year method that she's chosen. Now remember too that the distributions that happen with the inherited IRA are taxed, obviously, and there's not going to be a 10% early withdrawal. In TJ's case, she is 58 years old, so that 10% penalty typically for IRA withdrawals before 59 and a half is not going to apply to an inherited IRA. And then the rest of the assets, the money that's not being distributed to her within this 5-year window, can continue to grow tax deferred up to 5 years. But pretty much after 5 years or at that time limit, this money has got to come back to her. It's got to be fully exhausted. It's got to be taxed completely, and so that's what's going on here. The other thing too I will mention is that TJ also has to name her own beneficiary to this particular inherited IRA. What if something happens to her, right? So she's going to have her own beneficiary to this inherited IRA. So these are just some of the basics, a little bit of color to help you understand the situation. Let's take a look now at the first grading category, which is cost. So we ask a couple of key questions when it comes to cost and your investments. Is how does the entire portfolio, how does it do in terms of cost? Its overall cost compared to a blended mix of passive index ETF benchmarks. Is it higher or is it lower? What about the portfolio's transaction and brokerage costs? Are they abnormally elevated? What about hidden fees within the portfolio that the investor has missed? Is there any of that happening? So these are some of the things that I take a look at when I analyze and grade an investment portfolio that you send me. And so there's 3 holdings right now in TJ's portfolio. It's a relatively simple portfolio. There's not a lot of holdings. It's not very complicated. So the first holding is the American Fund's Income of America Fund. That's ticker symbol AMECX. And then Caterpillar ticker symbol CAT, and then another individual stock, FCX, which is called Freeport McMoran. So basically 3 holdings. 2 of them are individual stocks. One of them is an actively managed mutual fund from American Funds. The biggest holding here is the mutual fund, ticker symbol AMECX, $262,000 there, and I'm rounding these numbers. Caterpillar, $48,000, and then Freeport McMoran, $12,000. So most of this portfolio, this $322,000 portfolio, is in a diversified, actively managed mutual fund. So the real cost here, and there hasn't been any trading going on in this account whatsoever. Of course, actually, there are sales that are being triggered to liquidate this account so that TJ can pay taxes on these inherited IRA distributions. So yes, that transaction's happening. But beyond that, there's really no other, what I see, excessive trading costs or brokerage costs happening. Also, this portfolio is not being currently managed by a financial advisor, although it's interesting because American funds are what we call load funds. Typically, there's a sales commission that's triggered when you buy an American funds mutual fund. And this is the A shares. So at one point, there was a financial advisor involved because the A shares are what we call an upfront load. But it appears that whoever that financial advisor is that sold the TJ's family member, this fund is no longer in the picture. So the annual expenses for this fund, again, that's the American Funds Income Fund of America, ticker symbol AMECX. The annual expenses are 0.55% or 55 basis points. This is a blended fund. So it's got some stocks in it, mostly U.S. stocks. It does have some non-U.S. stocks, about 18% non-U.S. stocks, and then it's got about 30% in bonds. So it's, again, across a number of different asset classes. It's got some stocks and bonds in it. And then, of course, the Caterpillar and the Freeport McMoran are just individual stock holdings. So this particular portfolio, I would say, has some room in terms of cutting cost and reducing expenses. 55 basis points or 0.55% is a little bit on the high side compared to what you can get in terms of the same exposure to stocks and bonds using index ETFs. So that's the benchmark of cost that I use. It's the benchmark of cost you should be using. We never use peer groups. Peer groups distort what your true cost should be. We always look at what the passive, the closest passive index availability or choice would be. That's the correct barometer for measuring cost, and that's what we use in terms of the portfolio report card. So, TJ, you got some work to do in terms of minimizing investment costs. You can easily reduce cost, I would say, another 70-80% compared to what you're paying now. So in the next segment, we'll take a look at some other areas. We'll take a look at risk, diversification, taxes, and performance, and then we'll give TJ a final report card grade of A, B, C, D, or F. This is the Index Investing Show. I'm Ron DeLegge. If you'd like to join us, 844-305-7800 is the number. At Index Show is where you find me on Twitter. We'll get you caught up what's going on there. And also, we'll take a look at some of what the key industry sectors are doing and some of the ETFs tracking them. Stay with us. I'll be right back.
Do you have an investing or retirement plan question? Tweet the program right now or follow us on Twitter at Index Show.
First, the basic idea. Working people defer the money they earn. Next, that money can be used in the future to pay for basic living expenses, so long as it's wisely invested. To acquire these skills, tune in to the Index Investing Show with Ron DeLegge, a carefully designed program for working people who save and invest money. The Index Investing Show is now available at iTunes, Spotify, YouTube, and other world-class platforms.
Do you have an investing or retirement plan question? Tweet the program right now or follow us on Twitter at Index Show.
All right, some things on our Twitter feed at Index Show. That's where you find us on Twitter. So some of the things that we've been talking about and are following. How did index investing begin? I've got a link to that. We discussed that on last week's program, so if you missed it, you can hit our Twitter feed at Index Show and be linked up to that. Also, bond market's March Madness leaves Treasury yields on track for their biggest monthly drop since 2016. Holy Toledo! What the heck is going on with Treasury yields? Well, you know, they've been going berserk. And if you're a bull, that's been a great trade. Remember, the relationship between bond yields and bond prices is opposite. So when bond yields are falling, just had their biggest monthly drop since 2016, when they're falling this sharply, that's great for bond prices. And if you've been long, ticker symbol TMF, which is the direction daily 3X long-term U.S. Treasury ETF, TMF, put that one on your radar. That has gained just over 12% since the start of the year. But if you take a look at the chart, my goodness, the March chart is unbelievable. This particular ETF was down 7% at the start of March. It ended the month up 12%. So it made most of its year-to-date, well, it actually made all of its gain that it's had in the month of March so far in 2019. So a tremendous move in TMF. And then you've also got a link to an article that was posted at Vanguard, a nice overview about the advantage of Roth IRAs and Roth IRA conversions. As you know, those of us that are longtime listeners to this program, we are fanatics for Roth IRAs and Roth IRA conversions because we understand that taxes in the future, in the very near future here in the U.S., are going to be substantially higher. And so we've got a window by which to convert money, pay the taxes now. We'd rather do it when taxes are at historical lows, at least compared to where they were in the 70s and even 80s. Taxes are substantially lower today. So we'd rather pay taxes now, get them out of the way, and remove the partnership with Uncle Sam and instead of rolling the dice and seeing whether taxes are going to be higher or lower or the same in the future. We happen to believe the philosophy of this host believes that taxes will be substantially higher. And the reason is there's a four-letter word, and that four-letter word is called math. There's no way around it. The U.S. government cannot afford to keep paying Social Security and Medicare and all these expenses, national debt, defense, paying for border walls, and all these things, paying for disaster relief and these things that keep coming up that are multi-billion-dollar expenses and even worse, multi-trillion-dollar obligations that are unfunded and continue to be on this spending pattern and not have it somehow impact us as taxpayers. So Roth IRA, Roth 401k, Roth conversions, big fans of all of that. So there's a nice article again on our Twitter feed. You can read more about that at Index Show. And also a link I should mention, actually a retweet of ETF Guide. Speaking of taxes, people who say that U.S. income taxes are too high need a serious reality check because they're not actually high when you look at history. So we look at the top marginal income tax brackets from today versus the past, going all the way back to 1913. So there's a nice chart there helping you have some historical context of where we're at in terms of income taxes. Now, in terms of industry sector performance and the ETFs tracking them, there's a couple of funds that I need to alert you about that have been big-time winners thus far in 2019. XLK, which tracks the technology sector within the S&P 500, ahead by almost 20% since the start of the year. That's been a great performer. XLRE, which tracks REITs within the S&P 500, ahead by 17.5%. XLI, which tracks the industrial sector, ahead by just over 17%. XLI is an interesting sector because one of the companies within that sector has been in the news and has been on a wild ride. That's Boeing. And XLI, despite the fact that Boeing is a major component, I mean, it is the top holding within XLI. And Boeing has been obviously dealing with some issues related to that 737 MAX jet airliner. And so despite that volatility, despite the roller coaster ride that particular company is facing, XLI as a group has still been a great performer. Think about it. You've got other great companies within that industrial sector holding it up and performing quite well. Honeywell, 3M, Union Pacific Corp, United Technologies, UPS, Caterpillar. These are just some of the great companies, world-class, that make up the industrial sector. So that just helps you understand why diversifying away from that single stock risk is often a wise strategy. So those are some of the top industry sectors within the S&P 500. All the industry sectors, all 11 within the S&P 500, are positive thus far in 2019. So there again, what does that tell you about the financial markets at this particular juncture? Well, it tells you that the upside momentum, or this momentum in equity performance, is still to the upside. 844-305-7800 is the number. You're listening to the Index Investing Show. We're doing a portfolio report card on today's program for TJ in Glendale, Arizona. She is 58 years old. She's got a $322,000 inherited IRA. It is a non-spousal IRA, so she's begun taking, or she will have to take distributions within 5 years. This is just recently inherited. So that's going to be something that TJ starts doing. Now, in terms of the cost of the portfolio, we looked at this earlier. We told you that there is some room to cut expenses. The biggest holding is ticker symbol AMECX, which is the income fund from American Funds. She's paying just over 0.5% or 55 basis points. And that is, while it doesn't sound high to some of you, it is substantially higher compared to what similar funds do in terms of index funds tracking the same area. So there's a lot of room to cut expenses. By my estimates, at least 70-80%. So TJ's got some work to do there. In terms of risk, the portfolio only has 3 holdings. Caterpillar, Freeport-McMoRan, those 2 individual stocks make up a very small portion of the overall portfolio. The bulk is in the income fund, which is diversified across stocks as well as bonds. And I would say, TJ, as a 58-year-old female who has got only a couple more years to retire, I don't see much of a margin of safety in this portfolio in terms of having a cushion of money that is not exposed to any market volatility, any market risk, and really 100% of the portfolio is fully invested. And so there's some tweaking that needs to be done in terms of having a margin of safety that's adequate for TJ and takes into account her retirement and her retirement window or time frame. I'm Rhonda Legge. This is the Index Investing Show. We're going to finish this portfolio report card. We'll take a look at diversification, taxes, and performance, and give TJ a final grade of A, B, C, D, or F. I'm Rhonda Legge. This is the Index Investing Show. Be here or be nowhere.
You're listening to the Index Investing Show with Rhonda Legge. Subscribe to our podcast at iTunes, Spotify, or Google Play. Be sure to leave a review.
All right, welcome back from the break. I am your host, Ron DeLegge, and we're here. If you'd like to join us to talk about anything financial on your mind, 844-305-7800. If you were not able to get in, you can follow us 24/7 on Twitter, at Index Show. You can hit me up there. And if you've got a question about a particular stock, mutual fund, ETF, or anything you've heard on the program, we can talk about that. Now, those of you that have been listening to the show wondering, well, what about my own investments? Am I on track to reach my financial goals? Will I have enough money by the time I retire? Is my money properly positioned? And is my portfolio doing what it should be doing for me? Should be helping me get ahead. If you're unsure about these things, even if you do have a financial advisor and you want to find out exactly the diagnosis of the health of your investment portfolio, you can go to portfolioreportcard.com, reach out to me, and make a request. I'll tell you exactly how your investments are doing in 5 key categories. Some rules as far as getting a portfolio report card. There's 2 main rules. Number 1, I do not grade theoretical portfolios. It's got to be real money. So that is rule number 1. Number 2, you've got to have at least 1 year of investment performance backed up with statements and showing me actual positions. So these are some of the key rules. Those are the main 2 rules. And of course, rule number 3 is you have to make a formal request. I don't take requests for portfolio report cards via Twitter or on the phone. You got to go to portfolioreportcard.com and make a formal request. So, getting back to TJ in Glendale, Arizona, 58 years old. She inherited a $322,000 an IRA, which is now what we call an inherited IRA. This was something that she got from somebody that was not her spouse, a family member. And so we took a look at the portfolio in terms of cost, risk. Now we're going to take a look in terms of diversification, taxes, and then performance, and give TJ a final grade of A, B, C, D, or F. So diversification, what is that all about? Well, the main thing we look for when analyzing an investment portfolio is, does it have adequate diversification? Does it have exposure to the 5 major asset classes: stocks, bonds, real estate, commodities, and cash? Is there an imbalance in diversification, or what I sometimes call under-diversification? So in this case, TJ does have exposure to stocks and bonds. That particular fund that she owns, AMECX, has exposure not just to U.S. stocks, but also international stocks. And there are some bonds in that particular fund. So she does have exposure to those 2 key areas. But Mrs. Real Estate and Commodities, 2 major asset classes, no exposure there whatsoever. The other position she's got is Caterpillar and Freeport McMoran. So TJ comes up short in terms of diversification. Also, there is a little bit of cash in the portfolio via that mutual fund, but no cash whatsoever in terms of like a money market fund in this portfolio. So there is some work to do in terms of diversification. In terms of taxes, we asked the question, well, is the portfolio tax efficient? Is this portfolio protected against the threat of higher taxes, not just obviously taxes right now, but taxes in the future? Does the portfolio, its design, create any potential tax problems for the investor or unnecessary tax liabilities? And so when we look at a portfolio, things I look for, if it's an IRA type of account, is there premature distributions happening from the account, which obviously would trigger not just taxes but also penalties if they're happening before 59 and a half. That's one thing I look for. Also, outstanding loans in a 401k plan, although you may not think that there's a tax problem there, it is what we call a rain cloud. Because if you leave a job or if you're terminated and you've got an outstanding 401k loan, guess what? That loan you have to pay it back. Otherwise, it comes back to you as taxable income. And if you don't have the money to pay that back, if that loan is a really big loan, that could potentially be a very, very problematic tax problem for you. So in this case, though, this, again, is an inherited IRA. And so TJ has got to take mandatory distributions. She's chosen to do the 5-year method and basically take that distribution. It's got to happen within 5 years after the death of the person that is gifted or bequeathed this IRA. And then as she takes out money each year out of this inherited IRA, then she's taxed. Now, she is 58 years old. Typically with an IRA, 59 and a half is the rule, right? If you take money out before 59 and a half, there's a 10% penalty. She's 58. Those rules do not apply to the inherited IRA. So doesn't have to worry about that. And so in terms of taxes, I don't really see much of an issue here. She is limited. She can't really to defer taxes in IRA. Of course, the money that she's not taking out can continue to grow tax deferred, but she is eventually going to exhaust this portfolio. It's all going to be taxable to her. But after that, what does she do with the money, right? That becomes another conversation. Does she take the money and put it into her own retirement account? Maybe something like a Roth IRA if she qualifies, or some other type of retirement account. I would definitely favor the Roth IRA, but these are questions that TJ has to answer and think about in the context of her own retirement. So the last grading category is performance. And I calculated a 1-year performance, factoring in distributions as well as additions, contributions to this account. We always do that. We never want to have contributions or withdrawals distort the performance numbers. We always want to account for that. So TJ's 1-year performance, according to my calculation, was just over 6%, 6.1%. And how did that compare to a benchmark of index funds that matched this same asset mix? Well, it came up slightly short. I came up with a return, our blended benchmark, of 8.6%. So we can see that this portfolio underperformed over the past year, and that's never good. You always want to be at the same as the benchmark or higher. And so the overall grade for TJ's portfolio is a C. That is the final grade. And one other thing I will mention is there's no written investment policy statement that TJ has at all, and that is a mandatory document that all investors should have. And that is something that is factored into the overall grade. You don't have a written investment policy statement that describes exactly what the purpose of this money is, what the objective is, what the goals are, what the financial instruments you're going to be using to reach those goals, what the time horizon is. You don't have a written document that explains that, then you have a serious problem. A retirement plan is not a plan unless it's written. And so with an investment policy statement, you can get those from a financial advisor. Most advisors, if they're charging you, will present that to you. But you can also get that through my online classes, indexshow.com. I have a template that those of you that are do-it-yourself investors can use. And so thank you, TJ, for taking Ron DeLegge's Portfolio Report Card Challenge. Be sure to join us again next week. We'll be here, same time, same station, talking the birds and the bees of successful investing. And until we meet again, may the market indexes be with you.
Thank you for listening to the Index Investing Show with Ron DeLegge. Connect with us on the web at indexshow.com. And be sure to subscribe to our podcast at iTunes, Spotify, or Google Play.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.